This has been a crazy week in the markets. The NASDAQ has been up a lot. The S&P has been up a lot all this week. And that's something that we'll take a look at in this video. And what we want to know, what we really want to know, that burning question is, will the bull rally continue and turn this into our next bull run? Or is this just another bull rally in the midst of the overall bear market? So we'll take a look at that. We'll talk about what's coming up and what I think is going to cause this market to make a final decision on whether we're going to have a full-on bullish breakout or if we're going to continue the bear market. I'm Dr. Stock, Doctor of Education. Let's get right into it. So this large candle here is Friday of last week, and we have closed above that consistently for now 4 days in a row, and really having a strong trading day today. Tesla, I believe, had a lot of influence, at least initially, and then GDP coming in, the Q4 advanced estimate coming in at 2.9%, slower than the 3.2%, so slightly slowing of the economy in Q4, at least as per the advanced estimate. The revision comes out at the end of February, so looking at that second estimate when it comes out is also going to be crucial for us to watch those economic indicators as they come out. So this has been great, and what we know is it enough to really signify that we've broken out of the bearish cycle? And if we zoom out a little bit so we can look left, you can see if I move my cursor up that we haven't hit the top of this yet. So we're still down below 4,100, and you can see back here that we topped out at that even though we closed lower, but we go back to this tall green candle here, which closed at 40.80. We're still just a little bit shy of that, and really overcoming those previous highs is something that's going to be better confirmation that we have a rally that could keep continuing. So let's move on over to the NASDAQ. And when we look at the NASDAQ, this one's even crazier. So as we zoom in on this, we have a near even, a little flat top, a big old tabletop coming out right here for what we have on the NASDAQ. If I zoom out a little bit more, it looks like between this flat bottom that we have and flat top, it could be that we're currently range bound, and really we need to break out above those previous highs in order to do that. So this long bodied candle that you see right here being a red candle means that the close is at the bottom of 11,256 it says, and here we close significantly above that value. So really we can look back here. Even though we hit these highs and that high was a bit higher, that was not something that was sustained throughout the trading day. However, when you look at these green candles that are over here, we did close above those previous highs as well. I don't think that this is enough to say that we've firmly broken out of it, although I would say that it's a good start. So I switched over to the Qs, QQQ, which tracks the NASDAQ, and you can see that we had a strong start to the day. Big old red candle right here around 11 o'clock dropped us back down, and then we climbed back out of it. It's a strong amount of volume to close. So it was a roller coaster of a day, volatility intraday for the NASDAQ, but still, I wouldn't say that it's enough to break us out of where we're currently at, even though we broke above this diagonal trend here, that horizontal line. I'll draw it on for you. This is something that we really want to see firmly broken in order to keep the rally going. There we go, horizontal line. And we will slap it on there, and you can see that's a fairly even top on this thing, and breaking those previous highs is going to be really good confirmation. Now, as you do look at the Qs that we have here, you can see we did close above the 200-day moving average. That's awesome for us. Also, if we continue the run, we start to see a golden cross where this 200-day orange simple moving average that we have here and the 50-day simple moving averages, that moves up as we start to see the two of those inflect. And start, well, actually the blue one, the 50-day has already started turning, because that's something that's a little bit more reactive, being a shorter term. And this longer term trend would tell us more about the bear market that we're currently seeing. Seeing the orange line flatten out would be incredible for us. Seeing blue cross orange to signal that we have that golden cross, that we have that bullish breakout, would also be very significant for us. So just a quick look at the GDP charts. As we take a look at the GDP charts, you can see the pandemic in here. Always fun to look at just how low Q2 of 2020 dropped down and what the quarter over quarter change looks like going into Q3. So you sort of have that interplay going on, and you can see throughout history, through these past 4 years that are listed here, Q4 falling, pretty much in line with some of the more regular quarters that we had. It'd be nice to see this over a longer history. So we can see that it is expected throughout some point in 2023 to hit that recession. So that's where we see that GDP go negative for 2 consecutive quarters. So you can see it happening here in 2020 for Q1 and Q2, also in 2022 for Q1 and Q2, leading to that technical recession. So that's something expected in Q3. We'll have to see if it hits. Some people are saying that it would be later in 2023 or at some point in 2023, early 2023. Really, it depends on the strength of the consumers and what we see come out in the economic reports as we move forward from here to say whether or not a recession is something that we're going to see. The PCE, when it comes with personal income and outlays, should be shed more light on that tomorrow at 8:30 a.m. So be on the watch for that to come out, and also watch how the markets react. And that should tell you a little bit more about how to digest that information that comes out. Really, the big decider in that whole bullish or bearish moment, in my opinion, is over here with the CME FedWatch tool that talks about the rate hike that, well, currently is expected right now at 25 basis points on February the 1st following the FOMC meeting. As per this tool, there's a 25 basis point hike in the rate hike in the pipelines. It does seem a little bit suspect when we look at the markets that people are seeing the reduced inflation, that's going to cool down, and maybe they're thinking that the recession, should we have one, won't be that bad. Will it be, as the banks say, that they expect maybe a mild recession to come our way in 2023. So right now, I would say that those fears are subsiding. We can see it happening in the markets, and with the good news coming out about inflation moderating and also GDP slowing down, even if it hasn't gone negative yet, I think that there's a lot of hope going on in the markets, allowing them to elevate off their lows. Now, we'll see as this meeting comes out that if we get exactly what the Fed, what we expect the Fed to give us, that 25 basis point hike, I don't know that the market is really going to react to that very strongly. However, if for some reason they come out and pause, that would be, I think, a moment of celebration in the markets, that you would see a very steep jump from where we're at. And if we haven't already broken resistance by that point in time, I think that we would see that happen. In the meantime, based on the economic reports that happen, we might see the euphoria calm down a little bit in the markets and return back to some of the other lows that we've had, awaiting further information to come out. When we look back at November for the personal income and outlays, which comes out tomorrow for December of 2022, when we look down here at the PCE for the price indexes, when we look at a month over month, 0.1 and 0.2, I think the 0.1 is going to be a little bit high for December. I think the expectation right now is a decrease of 0.1%, so negative 0.1. We'll watch to see that come out. It is closely tied, or I should say highly correlated to what happens with the CPI, even though they are calculated differently. So there will be differences that happen with them. So we did see that decrease with the CPI. When we looked at all items, so for the PCE, we're also going to see something very similar to that. So negative 0.1 to be expected, I think, is something very reasonable to see. And when we look at the statistical occurrence of negative 0.1%, it is reasonable to assume that we'll get that sort of reading for PCE. A lot of it was contributed to the drop in energy prices for the CPI. So that could also happen to PCE. When we look at this one, we exclude food and energy at 0.2 for November. I believe that also matches the expectation. If it's not 0.2, it's 0.3. And I think 0.2 sounds about right as we move into see that core PCE tomorrow. So let me summarize this for you. So GDP coming in at 2.9% for the advanced report for Q4 of 2022 is something that is good for the markets because it is a drop in GDP, which we would do. That means that there still is a growth because it's positive. It's just slower because it's not as high as a growth as it was in Q3, which came out at 3.2. So that would be signs to the Fed that the economy is cooling. If the markets have more reason to be convinced that the Fed is not going to tighten any more than 25 basis points, which, like I said, is a near certainty as per expectations, then the market, I think, is okay with that certainty compared to uncertainty, which is very unsettling and makes investors jittery. As more reports come in and give us more indication that inflation is moderating and that the economy is slowing down, that means that the Fed has less of a reason to continue to hike rates, that what they've already done has worked. And so it could encourage a sooner pause from the Fed. Even if we do get those 25 basis point rate hike on February 1st, as is anticipated, it could be something that lowers the expectation for any more rate hikes by as soon as March. And that would be something that, as we get that certainty, could cause a further rally in the markets. In the near term, it really is a coin toss as to whether or not we'll see, maybe if PCE comes in surprisingly low tomorrow, that not to the point where it indicates that we're going to get to a recession, too big of a recession too soon. And I don't think that we will, not with its correlation to the CPI and the other reports that we've seen in GDP coming out, which also reports on quarterly information for PCE as well. I just don't think that we're going to get any real big surprise in PCE when it gets reported tomorrow at 8:30 a.m. Consumer confidence from University of Michigan, when that comes out, we've already got the preliminaries. I don't anticipate much of a change from that either. From this point all the way up until the Fed meeting on January the 31st to February 1st, I don't see any real big changes, black swan events aside, to what the Fed might happen to do for their meeting. So will the markets go higher? I think it's possible that they do, but any sort of surprise or expectation that could be misconstrued as negative or indicate that there'll be more rate hiking for longer could be something that would bring it back down. So we'll see, especially in the NASDAQ, is it going to stay range bound and we're going to drop back down to previous lows, or is it something that's going to allow us to stay elevated for a little while longer? Honestly, it is possible that we see a little bit more of a sustained rally. And as we watch for recession information, because honestly, I think the recession is something that hasn't really been paid enough attention to yet in the markets. I think for right now, that near-term victory of watching things, watching inflation moderate, watching economy slow a little bit, I think that sort of celebrating that time right now. And depending on how things go from here, if we watch January and February reports come out, and we see significant slowing from where we're at right now, and we get the second estimate of GDP at the end of February, and even that points to a lower revision from the 2.9% it's at. And if signs do point to further economic slowdown from where we're currently at, that could be good for a Fed rate pause. But if it is something that indicates too deep of a recession, that I think is when we start to revisit the lows that we've seen, the lowest lows that we've seen in the S&P and the NASDAQ in the past several months. As earnings season plays out, I think that we're going to have other buying opportunities that take place. One of my recent favorites is watching NVIDIA and looking into their market position as far as AI, machine learning. I think that they're very well positioned to capitalize on that. So that's something I'm currently looking into, possibly to make an investment on that. And if there is any sort of drop in the near term, that could be a very good buying opportunity for me, should I decide to make that investment. So thank you guys for your time. I really appreciate it. It's a lot of fun making this video. If you'd like to support what I do, check out the links down in the description. I'm Dr. Stock, Doctor of Education. We'll see you in the next video.